All right. Today, I'm just going to be going over how to do a DCF just for the investment club. This is going to be purely the modeling part. I'm not really going to go too much into the conceptual portion behind it, although I may make a separate video on that. But we'll see. First thing you want to do when you have a company is to make sure, well, like one, that they're not a sin stock or vice stock. You can look up what that is. I mean, use your best judgment. It's really just like if they are mainly a oil company or, a consumer weapons or adult entertainment or illegal drug company, stuff of that nature. Um, Not even illegal drugs, but you get the picture. If it's something of that nature, then obviously use your best judgment, talk to people about it. It's unlikely they're going to be able to pitch it. The next thing you want to make sure is that they have an ESG rating that is double B and above. And so the way to check that, there's a couple ways. If they're not on this website here, MSCI, like MSCI ESG ratings, you just go in here and reminder, yeah, we need above a double B, right? So anything BB, or AAA works awesome. But you just type the company name in here. There's a chance that this is not working because I'm on a private browser. So yeah, when you type it in on here, whoops, just don't use incognito for that. It'll pop up with the company, and you'll go to this tab, and you'll see that Meta is B, which means we cannot currently pitch it. It's my understanding that these ESG ratings can change. And it's part of the reason why I'm doing the example here is on Meta because it's a company that we currently cannot add to our portfolio because of their laggard ESG rating. So back to this. Your company again would have to be double B and above. But if it was one that you could pitch, you'd then search into FactSet, which hopefully you should have a FactSet login. If not, do that right now because it takes a little bit of time sometimes. You go to the snapshot, and then we kind of just start working through this. And so you see your share price. I would do this as of like a close, so it's not moving on you, but it's currently 674.33. Number of shares outstanding. Normally, I just go to financials. Key items normally has most of the stuff you're looking for. And if it doesn't, you can always just search for something in here. So for example, in this case, I don't see shares outstanding, but if I want to go to shares outstanding, it has all the options here. Um, and so, I mean, I'm just going to look at total, but I'm probably going to use diluted here, but there probably should not be much difference. Yeah, so I am going to use diluted shares outstanding for this. Um, Actually, yeah, no, yeah, use diluted unless you have rationale for another. The difference is diluted just normally includes more things like employee stock options, warrants, restricted stock units, stuff of that nature. So in this case, it is that number should be, and you can always click on things here to get more clarification in millions. So just something to keep in mind is that this is 2,600, so it's actually 2.6 billion shares. Anyways, um, another thing to keep in mind is there's a chance that, sorry, I have mine in quarters. There's a chance that your sheet um, looks like this, where it has the year on the left and then that on the right. The first thing you want to do is go up here to this button and switch it because this will put it in this format that's nice. Because later on you'll see here as we go through this template, the way that it's set up is so that you can kind of copy paste it over without having to do too much work. And so if you have your fact set up like this, it's a lot easier. Okay. Well, market cap and this, honestly, you can probably just pull it from here. Um, Fully diluted market cap again, because we use that diluted shares outstanding. It is 1.75. Okay. And so this is in billions. They are a $1.7 trillion company. So this is 1,756.49203. Our ESG rating, as we saw, was, I believe it was double, or no, it was whatever was below. It was B, which it means it would not normally be able to be pitched. But again, this is just an example pitch. We are not adding meta to our portfolio. Okay, so now moving on here, we're going to first start with the income statement. Might look really scary, but it's really not that bad. A lot of these div zeros are just because we don't have numbers in yet. And so when you go here, there's two ways you can do this. One thing to note, we're currently January 28th. I think Meta reports earnings really soon. They do like tomorrow, I think. Okay, yeah, they report earnings. They do report earnings tomorrow at 2 p.m. So when it gets close to earnings time, there may be this LTM column. You do not want to use this because again, this is an estimate. This is not confirmed by the company. And so like when you download this, this is the first way you can kind of import their financials into Excel is if you download the workbook. It should, there we go, it should pop up here. Oh, okay. Maybe using incognito kind of messed me up here, but um, and it'll give you all their financials, and you'll be saying, okay, well, this is a pain, but you can just basically go like this. Make sure again that you're not bringing over this 2024 LTM because this is, oh, actually, well, if it's a 2024 LTM, it's based off of their last quarter. So it's basically their year as of their last quarter, which again, we don't really want to use for this analysis, um, which I can talk about more later, but just don't worry about that. Session expired. I love backset. Okay, so now you have this here. This is the first way you do it, and then you start taking line item by line item, right? And you copy and you paste it over, right? And so you'll see that these numbers update because this is the growth or the percentage increase year over year. Wow, 31% sales. It's crazy for that 10-year average growth. Um, but another way you can do it, which I kind of just discovered recently, which is honestly better, is instead of doing that, notice how like these lines are literally only the like major lines here. And so what you can do is I'm just doing like shift and then clicking. So it highlights the whole table, copy it over and paste. Now, again, don't forget about that's, not technically part of their financials. But now you'll see you have like cost of goods sold, you have sales, boom, and you go cost of goods sold, and then you go gross income. And this is really great for some of the other ones like the balance sheet, just because it's okay. So in this case, SG&A needs to be broken out because you need the R&D. But yeah, so in this case, you do need to break that one out. But for most of the other ones, this is a super, super nice way to do that. I'm just going to paste it here. And we don't want that last year. And you'll see I'll kind of clean this up all at the end here. But if you want to do the more safe route of just not not doing it like this and just downloading the whole workbook, that's totally fine too. I just like this also from like the formatting perspective. It just looks a bit cleaner. You don't have to go through do as much formatting. So you kind of just go line by line here. It's really, really just nothing crazy. It's not rocket science. And so once you keep going, occasionally you get these NaN figures. In that case, you just have to like replace them with zeros. Um, honestly, I don't, you could probably look up what the error code is, but FactSet is not perfect. If it's something for like revenue or an actual important figure, then definitely look into it and maybe like look at their 10Ks. But if it's interest expense, I mean, it's a pretty small number anyways. It should not have a super material impact. And as I'm looking at this, I'm realizing that these numbers are in billions, which may pose an issue later on, but I'll get to that if it becomes an issue. Just because the way that this DCF is set up, it may be set for millions, but that's okay. Pre-tax income. income tax, consolidated net income. There really shouldn't be much of a difference in those numbers, but there. EPS. Again, they use that diluted. So it's a good thing we use diluted for everything else. What else are we looking at here? Dividends per share. It is zero because they have no dividend, I guess. And one thing you can do, I mean, to confirm that, again, you're going to get div zeros here because you're dividing by zero. This was like 5 and 5 or something. Or basically, if these were actual like all numbers, like it would work. Whoops. Um, but because of the way that it's set up, because Meta, does Meta have dividends? They do. Why does FactSet not pick that up? Is the question. Um, oh, it does say 1.5. Oh, so they just started issuing dividends. I mean, a way you can check this, there's probably a couple ways, but the way I know how to check this is if you go to Yahoo Finance, you can probably find it in FactSet, but look at historical data and then go to dividends only, go to monthly, and just go like max. So yeah, they started issuing a dividend this year. That is why that's showing up just now, which is funny. So this normally won't happen to you, and it's because it only started happening in 2024 that they had a dividend. And so in this case, don't worry about it. You can just kind of put zeros there, and then same thing here. Um, because in your projection, well, if you really wanted to, you could project their dividends. But in this case, it's such an immaterial amount, it really wouldn't matter too much. So don't worry about that if that somehow happens to you. I find it that's like the first time that's ever happened to me, and so I doubt it'll happen to you. But if it does, don't freak out. There's your EBITDA, EBIT, and depreciation and amortization. I don't know why, but we have two kind of lines for EBITDA. It didn't really matter. But there you are. And so this is the income statement fully done. Now that it's done, you can just take this whole table and just delete. And so this is all done. You do want to mess with these assumptions. I'll talk briefly about these. But basically, this can be where you make your adjustments for your predictions. The DCF is largely driven by predictions. And so say for example, they've somehow performed, they've had a 31% sales growth for the past 10 years. That's pretty impressive. But you don't think that that pace is going to continue. Maybe you've seen somehow through industry reports or through your research that their input costs are going to go up. So you think their cost of goods sold are going to go up. Again, this is Meta is mainly um, online, kind of SaaS. So I doubt this would happen. That's why their cost of goods sold margin is so low. But you add 2%. Notice how your projected is just that plus that. So now, if you look at this, it's saying that each year this is going to grow by 19.37%. So basically increasing your cost of goods sold. And the same thing works, for sales. Obviously, if you increase your, sales by a lot, like your projected sales, like this is $762 billion from 134 billion, 5 years prior. Do you really think that's realistic? And so normally what I like to do is get the whole model down, fill out all these tabs, and then go back and make my assumptions. So with that being said, we're going to move on to the balance sheet here. And this one with this kind of copy paste method moves pretty quick. But a lot of this is just a little bit of just a little bit annoying copy paste. Do you want to make sure, okay, good. They don't have any kind of prediction on the balance sheet, or I don't think the cash flow statement for that matter. They do for the cash flow statement. So be careful with that. But these, like, you can kind of just go down. They do cash, short term, Other, okay, it goes inventories then. So, oh, we don't have inventory on here. Another thing that's nice about this is if you want, you can also like break it out a little bit more. Mm. Oh, it's because they don't have inventory. That took me a second, but that's the reason why they don't have a line item for it. Meta has no inventory. It makes sense. Okay, so we got short-term receivables. I'm just going to copy these two first because there's going to be a gap. Inventories is going to be zeros across the board. Other current assets, and then it goes to net PP&E. Total investments and advances is the same as long-term investments here. Intangible assets, deferred tax assets. Do they have any? They don't have any. It's another gap. Normally companies don't have gaps. I guess Meta's a little bit unique. Oh, I just hit Control R on accident. Sorry. And so going here, they're oops, total current net PP&E. Wait, total current net PP&E. Oh, other current. Did I not copy other current? Ah, I didn't. That is my bad. Yeah. It's easy to make mistakes if you're not paying attention or you're tired like me. Um, but yeah, just take your time with it. They do not have any other, deferred tax assets. They do have DTLs, but you can check on here. Like you can just kind of open these up, but they really shouldn't. Yeah. And so we're just gonna go 0. Now you just have other assets, total assets. Oh, beautiful. All right. Moving on to liabilities and shareholders' equity. Start out with debt. Then we go accounts payable. Then we go income tax payable, which again is having weird numbers here, so we're just gonna put zeros. Just gonna fix these two while we're at it. Okay. So short-term debt, accounts payable, income tax payable, other current liabilities, total current liabilities. Beautiful. So we're just gonna copy this whole section over. Um, so now with term debt, let's see, long-term debt, we have that. Then we have the provisions for risk and charges is not on here. So there's a chance again that they don't have it. Mm, it looks like they do not have any other, provisions for risks, which is fair. So we're just gonna copy this one line item, then put again, zeros in here. Now we're on to deferred tax liabilities, then other liabilities and total liabilities. All right, beautiful. Next, move on to the very short shareholders' equity section, which is just shareholders' equity, equity, total liabilities, and shareholders' equity, which in this case, all these are pretty similar. Well, or at least these two lines are. There's like no difference between the equity and shareholders' equity in this case. Um, per share, it's just these two lines. Yep. And so the way that this forecasts net working capital, in my opinion, isn't great, um, but it still works. And so net working capital is effectively your current assets minus your current liabilities. You can see that kind of from here. Um, and the idea behind figuring this out is it's the kind of money that is tied up within the company and isn't really disposable for use, which I'll get into the free cash flow calculation in a minute here. But yeah, you can kind of delete this. Now this is done. Move on to the statement of cash flows. Kind of know the drill by now. This one should hopefully be pretty quick. Let's see. Net income, depreciation, deferred tax, other funds, funds from ops, working capital change. Awesome. So we can copy paste this whole section. Oh, that's right. They included this year. I honestly just delete it because it's kind of easy to mess up otherwise. But if you go over this line, you know you kind of messed up. That being said, by the time most of you see this, it'll probably have the 2024 over because right now we're in a weird spot where companies are reporting their 2024 earnings. And so we're still using 2023 financials, which arguably, if you wanted to really put effort in, yes, you should do probably a trailing 12 months from their last quarter. Um, but for this model use case, it's not going to change year over year. All it's going to change is the date. And so that's why I'm kind of just doing it like this because this is more like how it's going to look for you guys. Okay, but moving on, we have that, just net assets, sale, purchase other funds, that, cool. Copy, paste. Oh, that's interesting. Oh, I just missed it by a line. Another thing to be careful of is the cut function. If you do like, for example, if I like accidentally made this like a different line and I can your controller command X and then command V, notice how this formula still follows like it still basically follows this line. So you have to be careful. In this case, it didn't matter, but in other cases, if you cut on this model, it'll like mess with the formulas. So just be careful and honestly just undo if you make a mistake. Okay. Cash dividends, change in capital, issue reduction debt, other funds, no financing. Beautiful. Net change in cash. So you could find yourself, but we're just going to take this. Now we're on to free cash flow per share. We can take free cash flow here if we want, which is what we're going to forecast for our DCF. But now this is done. Now we go on to the more exciting part, the valuation page. And so in this, really looks kind of scary, but it's not too bad once you know what you're doing. Um, Again, yeah, this is the ESG site that I used. Just a rule of thumb, the year growth rate should be between 1 to 3% here, which I'll get more into in a minute. But your WACC or weighted average cost of capital is effectively how much money it costs for the company to raise just more, and it's associated with effectively the risk of the company. And so there's a lot of things that go into it. And honestly, we could calculate our own WACC, but for the matters of this, um, you can take your WACC from a couple places. WACC, their FactSet does have its own. I bet you it actually shows you the calculation. Yeah, it does. Interesting. Um, but it's nothing too insane. I mean, the only reason why I'm not having like us calculate on our own is because beta is impossible to find without like a Bloomberg terminal. Um, and so like any value you find online is just not going to be worth really calculating it for because they already have the equation already fully done. But they got 9.47. Another way, if you want to like look into this deeper, Guru Focus has it, and they have. Yeah, maybe not in this case, but in most cases they're pretty reliable. 1.7% is just insanely low, and that does not make sense. 807 by alpha spread, 9.1 from value investing. Um, yeah, that's 87 again. Oh, there we go. This is Guru Focus's actual thing. I don't know what that was on, but um, 11.46. So, I mean, I'm seeing like a number. I'll just put 9%. Normally, you want to do some of your own research, maybe look into it a little bit harder than how I just did. But for now, we'll put 9%, see what happens. Um, Now we move on to the next part. This is how you calculate your free cash flows. Basically, you're just calculating the amount of cash you're going to have on hand for the next 5 years. This is your stage one cash flows, if you're familiar with that term. And then you're discounting it to its present value using this discount rate. But next, we're going to move on to this. Again, rule of thumb, your growth rate should be between 1 to 3%. It should never really be over 3.5% or so. It cannot exceed the US GDP because the idea is that this is if your company were to grow forever, what rate would it grow? And so it just does not make sense to be higher. For now, we're just going to put this at 2%. Um, and so you'll see that this kind of auto calculates now. It pulled my final year projected free cash flow. It calculated my terminal value using that rate, using that WACC. So now discount discount that, or we'll sum the discounted now, and then sum those. Um, and then this one, you still need an industry multiple, which basically this is where it's a little bit tricky because FactSet does have stuff. If you have sources like PitchBook and stuff of that nature, obviously use that. But you can find this a number of ways. A couple ways here is to look through comps. You look at like industry specific EV, EBITDA multiples. For tech, there's an argument to use other, but in Meta's case, you see, okay, it's around 24.67. Again, on your own, I want you to do a little bit more research than this. You can also look here in the key items of the company, and you see EV to EBITDA 14.32. Okay, that's a bit lower. Um, Now you can also look at like Meta Equity Research Report, um, and like find something here. So, like Barron's, for example, has a price target, I bet, at range. Okay. And like you can probably look for multiples if they have any multiples. I don't think they do. But basically you can kind of go through reports and kind of see financials maybe. No, this is historical. Okay. Well, you can kind of just peruse and note that some, I guess, websites and reports are more valid than others. But at the end of the day, this is a very qualitative find, I guess, is what I'm trying to emphasize here. Um, so looking at this, yeah, they don't have anything about the multiples. That's okay. It would be nice. Okay, beautiful. Equity research report. There we go. EV EBITDA for 2024, 18.2. That's a great source here is this report by DBS, which is very helpful. So, I mean, I'm going to use probably around 19x just for now. And so you'll see we're actually almost done here. Oops. Basically, your debt. All you're going to do here is go to your balance sheet. Actually, do minus parentheses. You'll see why in a sec. You're going to do your balance sheet. You're going to take your most recent, so in this case, the 2023 current portion, or your short-term debt plus your long-term debt. Boom, 37.9. This is just going to be that. Oops. No, that's going to be that. Okay. So that shouldn't change across the methods. Now your cash. In this case, you're just going to take your cash and cash equivalents again from your balance sheet, unless it's a very immaterial amount, but I don't really want to get into that. And so again, you're just going to take the same value. So you may need to make these columns slightly larger. Your diluted shares outstanding is again from this page. And so all you're going to do is do that. And so you'll see that that this is like, okay, well, their current share price is 674.33. How is it projected that they're gonna have 37 cents or a dollar 11 cents? That doesn't make sense. And so that should be a red flag. And the reason for this is, like I mentioned earlier, the translation from the financials to billions. And so a way you can kind of fix this is to just make this number here divided by 1,000. And so now you get, you still have a div zero error for some reason, but So yeah, let's see what's wrong with this. The formula. Um, Beautiful. This is actually supposed to be in percentages. It's just because I messed with the thing. Okay. So you see here that Meta is 64% underweight. So this is saying your target price for Meta is actually $1,001 per share. Um, and this is saying that it's $370 per share. And again, they're currently at 674. This is, and then on over here on the side, this is just a blend or an average of that, saying it's going to go up 9%. This is normally when you would want to look into the research a bit more. Because quite frankly, this number should be a little bit higher. And so normally you'll look here, and you'll see, okay, what is it that's a bit off? Um, Networking capital is very low. It's fine. Depreciation and amortization makes sense because they have high capex. They have a high fixed assets because of, I believe they're probably high spending into AI infrastructure. Their EBIT is generally a little bit low, um, but it's really driven by this high capital expenditures. And this is where you can look into like perpetuity growth rate. You can also do a little bit more research here and see what other analysts are saying for it. Um, and so it's hard to be very it's like hard to be certain about this part because obviously there's varying opinions. That's why a market exists. But this just goes into the calculation for how you find it, right? And so I mean, in this, this is not specific to Meta at all, but I thought it said somewhere. It can't be more than yeah. So historical GDP is 4 to 5%. So perpetuity growth rate is typically between 2 to 3%. You can't, it cannot outpace the economy's growth forever. So like even if I made this like 2.5, we'll see what happens is this goes up, right? From slightly less to slightly more. Um, and so, like, okay, maybe you can make an argument for that. It is one of the largest, I think it's one of the 10 most valuable companies on the planet. So maybe they do, have a higher growth and perpetuity rate. Or maybe this multiple is too high and I actually go with 18x. See, that brings down the valuation. Um, I'll go back to the DCF now and I'll say, okay, their EBIT, right, is projected to grow actually pretty well. But as I mentioned, their capex is super high, and that's mainly attributed to AI. And so now, if I go here to the capex, yeah, you see it's 18% per year. What if I think that that's going to decrease? I'll say by 8%. That's a bit aggressive, but I think could be reasonable. And so you'll see that now it's only down 11%, and then this is up even more. And really, I think that's because the capex really drags it away because how you calculate your free cash flow is you take your EBIT, you adjust for taxes, right? So you subtract out taxes, you then add back your depreciation and amortization and subtract your change in net working capital, and then you subtract your capital expenditures. And so just by bringing down that capex figure a little bit, we got a lot higher of a share price. And it's also not a bad idea to compare your findings to other like equity research reports. So just to kind of go back here, not to kind of beat a dead horse, but if I go back to this equity research report, say share price is currently this is as of December of 2024. Keep in mind, that's another thing I probably should have mentioned is you should check when your reports are from because if it's old, it's irrelevant. Um, they don't have a target listed. That's interesting. Or maybe I missed it. Oh, 12-month target, 750. So they were projecting 597 divided by 750. I did it the wrong way around. 25% growth, which is pretty good. if you think on average the S&P, it's, I think predicted to grow at like around 10, 11% this year. So, Meta is generally valued pretty well, or it's generally pretty favorably looked upon, considering how well they've done, especially in the past few years. If you look at their price on like a 3-year basis, they're up. I don't know how to use Barron's, but they're up almost 70% in the past year, which is crazy. And so, maybe your, valuation here is realistic. Okay, but maybe you think the sales number, like I mentioned earlier, is a bit high. So I think that I'm going to shave off 5%. And so keep in mind what I'm saying now is that instead of their growth, their sales growing at 31% per year for the next 5 years, it's growing at 26% per year. Or I'm saying that, it's growing at roughly a sixth or a sixth less, is what I'm saying here. So be careful with how you input numbers there. Um, but maybe I, decrease that SG&A margin, and they did obviously have a dividend payout. And so, maybe I add that in. And so it's just stuff in this case, this won't really impact your model. Their depreciation and amortization is pretty high. I think it's going to continue to kind of be higher because of that CapEx spending. And so there's that as well, right? And so, all those things kind of move the needle on your valuation. I am not going to say that this is like the best perfect valuation for Meta, but I think it does the trick, especially for a pitch for the investment club. Also if you mess with your WACC, notice how much that changes the valuation. Like if I made this like 13%, like holy shit, right? I mean, probably shouldn't swear, but like it moves, it alters it a lot. And so I think around 9% is probably fair, but this is how you value the company, using the perpetuity growth method, right? Which is just this up here. And then this is with the multiple method again here. And this is the average. And so that's my kind of quick tutorial on how you use the Investment Club DCF. Don't forget about these assumptions as they are super important, um, and can really alter your valuation, as you've seen. And because of that, you do have to include these in your pitch, and you do have to kind of mention why you made the decisions you made. So do not omit that. Otherwise, you may get called out. So yeah, good luck, and feel free again. You can contact my email here. This is my personal email. So if you have questions, and I've already graduated, um, feel free to send me a quick note, or if you have improvements, let me know. The goal of this DCF is to not be insanely complicated, but still provide a valuable valuation for the company. So yeah, thank you.